To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee, with me Abha Bakaya, and our guest today on the show, Hiren Ved, who's the fund manager and one of India's longest running PMSs at Alchemy. Hiren, good to have you on the show. What are you expecting in the light of the recent volatility? It's going to be a sharp, short correction, or do you expect it a protracted period where money making becomes difficult?
Hi, Udayan. Hi, Abba. Thanks for having me on the show. Yeah, I think, we usually, when the first leg of the bull market from the bottom gets done, you usually have some sort of volatility. It's quite possible that once this volatility subsides, we may have the headline indexes going into some sort of a consolidation move, while individual stocks may continue to do well. That's usually the next phase of the bull market, where you have probably a consolidation at an index level, but then individual stocks and sectors will do what they have to do before the Nifty catches breath and then moves on to the next level. And I think we are going to probably see something very similar. We are currently going through a transition phase where we are moving from, probably the baton is going to be handed over from excess liquidity to earnings growth. And usually that transition period is a little bit painful. So we have to go through that.
But you're sure in your mind that this is not a end of the bull run that we've seen for the last 12, 15 months? Because another hypothesis could be that easy money is now over, and easy money was at the core of this bull run. And now we will probably see a different kind of a market and not the bull market that we have known for the last 15 months.
Certainly, this is not the end of the bull market for sure, but it's a different phase of the bull market, right? And, I think, as I mentioned, as opposed to the first phase where it kind of lifted all boats together, I think from here on, you may see a much more measured bull market where, the broad market kind of consolidates, but you have individual sectors and companies continuing to do well. I don't think money is just kind of completely gushing out, right? It's the incremental change in liquidity that matters. Again, I'm not a global macroeconomist, but if you look at two other instances in the past, which is between May 04 and the middle of 06, when the Fed funds rate went up by almost 400 plus basis points, the Nifty actually delivered a 45% dollar positive return, and so did all other global markets as well. And similarly, closer, when you look at the time frame between 2016 and 2018, when again Fed funds rate went up by about 230 odd basis points, and global markets still gave positive returns. And usually interest rate hikes are run concomitant with a very strong global economy, right? So we will have to see what the context is, but my sense is that we're going to see a very strong rebound in the Indian economy. And I don't think that, higher rates are going to kill this bull market. They may tame it for a while, but they won't kill it.
Typically, going by past instances, when you move from the first phase of the bull market to a consolidation phase, as you just outlined, if you are correct, and this is how the story plays out this time, typically how long is this period of consolidation for, where valuations pull in a little bit, pull back a little bit, and earnings growth slowly delivers and the market starts to find its feet and move up once again? What is this intervening period? I mean, generally, what is the time length?
So then I think we've seen it as low as 6 to 9 months and probably as long as 3 years, right? And there is no fixed formula what it will be this time. But my sense is that if our bet that the earnings growth is going to be quite healthy, 25% plus kind of compounding growth over the next few years, then I think the market on a forward basis is not that expensive. So my bet is that it could probably be a few quarters sideways movement before we start to move again, because then people will start looking at earnings in 23 and 24. Um, Obviously, there can be a lot of imponderables. You can never say for sure. But I think as things stand today here, my sense is that earnings has shown its hand. I think the way the Indian corporate sector has responded to COVID, when nobody expected, we got a 20% earnings growth in 21 and potentially a 25% plus earnings growth in 22. um, I think we are on course for maybe a few quarters of sideways and then a move back up.
So does this then change your strategy on specific sectors or themes that perhaps you were looking at, Hiren, or were you already kind of anticipating this slowdown?
So, Abha, I think, as the going goes, that every bull market has a new leader, right? And I think that the bull market, which started from the lows of March 2020, already showed its hand with the IT sector or the technology sector being the clear leader amongst the larger sectors, along with certain smaller sectors like specialty chemicals and so on and so forth. And we've also seen that the leader of the prior cycle, which is the banks and the private banks and the financials, which were leading the previous bull market, are now lagging it very clearly, right? So I think that there may be new leaders who will join, but I think pretty much it looks like, in our view, that technology will continue to be in the leading seat, and it will be joined by a few other sectors which continue to deliver very strong earnings growth. Now, mind you, these sectors itself, when they are leading, doesn't mean that they don't go into a correction or a sideways movement. But very seldom does the leadership change so quickly in a bull market, right? So I think we're going to do more of the same. And along with technology, I think a sector that at least we are betting on is the consumer discretionary sector, which got significantly impacted during COVID. I think as things open up, and I know it's a wrong time to say this when Omicron is on our backs, but I think eventually this phase will also hopefully fade out in a couple of months. And I think there is a lot of recovery and earnings power that is still left there. So I think a combination of technology and consumer discretionary and a few export sectors should continue to lead the next bull market.
This is an interesting hypothesis, Hiren, because the starting point of your bullishness is that the economy is bouncing back in India, and therefore it will translate into better markets, better earnings and better market gains. But the sectors which are actually leading the market have very little to do with the Indian economy. I mean, by your own admission, it's IT, it's specialty chemicals, it's probably APIs and pharmas. These derive most of their growth from outside India. And the sector which actually derives most of its growth from India, the banks and the financials, they are actually underperforming.
Yes.
What do you make of this dichotomy? I mean, is the market signaling something that we don't know?
No, then I think when I mentioned that, I premised my thesis of this new bull market on earnings. And actually, the sectors which have delivered the best earnings growth are the sectors which are leading, because the markets are very, they have their own wisdom and they understand that, right? And while a lot of the stuff that we believe will happen is in the future. We all expect the economy will bounce. It has bounced back, but we all expect that it will bounce back in the future. There may be other sectors to play that, and not necessarily financials. And I think because, in my opinion, there are 2-3 things that are happening in financials, though that is usually the best proxy that people want to use and play when they are very bullish on the economy. One, as I said, it's just historical trends that, the leaders of the previous bull market are never, ever the leaders of the next bull market, at least for some length of time. And I think that's got to do with the fact that, there was some sort of, a large allocation in the previous bull market, so much so that financials ended up being 35-40% of the index. So there is going to be some sort of a mean reversion, but it will happen in a very stealth manner, slowly over a period of time as other sectors catch up. The second, I think, is that uh, to my mind, I think the market's a bit worried about and is not able to price in the disruption that fintechs will do to the banking industry, right? Earlier, the banks kept the entire value chain of profitability to them. Today, that value chain is actually being broken up into several subsegments, and there are the fintechs which are attacking you in some of those subsegments of your value chain. Now, we don't know whether they make money or not, but I think the market's not yet decided or not confident that what the eventual impact of this is going to be, which we will only know over a period of time. And thirdly, banks and lenders typically tend to outperform when interest rate starts to rise, because that's when they get their pricing power back. That's when their liability franchise of having the ability to raise low cost deposits and then deploy it at better NIMs really starts to work. And I think a little bit of that is what is happening. It's not that our thesis that the economy is going to do well is in question at any point in time, but how you play that may be very different in this cycle than, let's say, what you've done in the previous cycle.
So let's come to the economy play in your hypothesis, which is consumer discretionary. What is the best way to play it in your eyes? I mean, is it through things like autos? Is it through things like some kind of consumer goods like electricals? Is it through real estate or housing? What's the best way? I mean, optimal way, because consumer discretionary is a very broad kind of a category.
So I think, Udayan, you mentioned some of those. I think, for example, we like the liquor companies. We think that, we've seen a great bounce back post-COVID. People have been holed up at homes. And, we've seen premiumization starting to move. More importantly, we are now starting to see that the regulatory environment, which was working as a headwind, is now becoming a tailwind slowly, as many governments realize that you can't kill an industry, which is one of the few areas where states still have some power to generate revenue, because under GST now everything goes to the center and then center gives it back to you, right? So I think that we like the liquor space. We think the QSR space should do very well. You mentioned autos. I think we're significantly bullish on autos. I think autos have gone through a long phase of consolidation, even pre-COVID. I think for 2-3 years, the sector had solid headwinds, and I believe now some of those are receding. And that's probably the better way to play. And maybe some capital goods companies could also be a good play on the revival of the economy. So I think there will be sub-segments in the consumer discretionary space, which we like, which will probably, do extremely well. Hotels, QSRs, liquor companies. I think that's the way to play.
Okay, and in terms of the kind of expectations that investors should now have on returns, Hiren, it's probably still too early to tell, but as you said, if we're to temper those expectations going into the new year, a year where we're starting it off with uncertainty and also expecting some action from the Fed, what would you suggest investors brace for?
I think, Abha, if our thesis that it's our thesis that I think earnings are likely to compound at 25% plus for the next couple of years.
Okay.
Right. I think if you look at the corporate profits to GDP between 2002-3 to 2007-8, we went from almost 2% to 7%. It was almost a 3x jump. Even if I assume that we don't have a leap which is as big as 3x, and let's say corporate profits to GDP go up to 5%, and the GDP compounds at 12% in nominal terms, I think we are talking about a 28-30% compounding in earnings. Now, people would argue that when the bull market in 2002-3 started, the starting point of valuations were far cheaper. Today, you're not as cheap. obviously, by any stretch of imagination. So I would say that if you would discount for the fact that our starting valuations are significantly higher and earnings are going to compound between 25 to 30%, I think it would not be a bad point to say that investors could think of mid-teen double digits compounding when it comes to markets. And obviously, there will be occasions when, or sub-segments of the market where you could essentially make a higher compounding. But I think that we are coming towards the end of the earnings drought, and we are beginning to see a strong recovery in earnings, and it's structural in nature, in my opinion. And therefore, I think 15 to 18% is something that should be possible.
Okay.
One last question, Hiren, on the new age companies, because I think now with the way markets are, we'll probably see not too many of these IPOs hitting the market as very soon. I mean, maybe they will start drying up. But of the crop which is listed already, some have done well, some have held up well, I should say, and some have not, like the Paytms and car trades of the world. Do you own any end of this digital spectrum? Maybe the ones which are actually focused on profitability and on not going to be not profitable for maybe 2, 3, 4 years down the line?
So then I think it's an interesting question. We're looking at that space very, very closely. Obviously, it's a space where I think valuations were clearly euphoric, and as you rightly profess, I think if the markets continue to the way they are, and if we've seen some of the tepid listings, I think there will be more sanity on that end of the market. The only stock that we liked so far is Nykaa. And, we believe that they have a great model, which you don't have to wait to see that whether it's proven or not. I think it's proven. Yes, valuations are expensive, but I think their execution has been phenomenal. And I think if they are able to add other adjacencies to what they're doing in the beauty market, I think that the stock could compound at a good, healthy double digit over the next couple of years. But mind you, there could be volatility. There's less history in all these companies. And typically during risk off, it's quite possible that, some people who were just playing momentum in some of these names could get off the train. But I think amongst all the crop that we see today, amongst the new age companies, by far, that looks like the best bet so far. And my view is that over the next 12, 24 months, we will get a very good entry point in some of the other names that you mentioned, probably at a valuation which will be far more attractive than what they're trading or maybe the price at which they went IPO. So I think it's about going to be patient. And, I think the laws of demand and supply will play. I mean, there was so much demand for these new age IPOs. And I think supply won't disappoint by catching up. And I think slowly and steadily valuations should hopefully get more rational. So I think it's going to be interesting times, but we will get to pick and choose some of these companies at the valuations which we believe will make money, and not necessarily at the valuations at which they listed.
Hiren, good talking to you today. Thank you very much for your time.
Thanks, Udayan. Thanks, Abha. Thanks for having me on the show.
Thank you.
If you like the video, do like, comment, share and subscribe.